The European Union's economy, the EU, is facing a trifecta of an energy crisis, high inflation, and an economic slowdown now. And this is where their central bank is working to raise interest rates to cool down inflation. But now the economy is really starting to see the impacts of the higher interest rates. And now the question is, what are they going to do? Are they going to continue to try to break inflation, which is breaking the economy? Or are they going to work to stimulate the economy, which could make the inflation problem even worse? Now, to put this in perspective, to kind of see what's going on with inflation in the EU, back in March of 2022, the United States saw core inflation peak at around 5.5%, and now the United States core inflation has come down to around 4%. During that same period, in March of 2022, the EU's core inflation was right around 3.5%, so less than what it was in the United States. But now the EU's inflation is now at 5.5%. This is around what the peak United States core inflation was back in 2022. And the United Kingdom's core inflation is currently at around 7%. So these European countries are still facing a significant inflation problem. At the same time, their central banks have been working to rapidly increase interest rates, but their economy is also slowing significantly because of the higher interest rates. To put this in perspective, in 2022, the United States economy grew by 2.1% and is expected to grow by 1.9% in 2023. In the EU, their economy grew by 3.5% in 2022, faster than what we did, and now they're projected to grow by just 0.8% in 2023. So what we've been seeing happen in the EU is inflation has kind of accelerated, or it's grown since last year, and their economy is slowing faster than the United States. And this puts a lot of pressure now on their central banks, because now the central banks have to make a decision. Are we going to continue raising interest rates to kind of bring down this inflation? But that's going to come with the risk of putting this economy into a deeper economic slowdown. Or do you start stimulating the economy, but then make the inflation problem worse? Now remember, inflation disproportionately hurts the working class. It disproportionately hurts regular people. And this is just one of the issues that the European countries are facing. The second issue has to do with the energy crisis, because if you remember, back when Russia invaded Ukraine, this was a huge blow to European countries, obviously to Ukraine as well, but financially, it was a huge blow to these European countries because many of these European countries rely on Russia for their energy sources. Russia is one of the largest providers of energy for the European Union countries, because the EU isn't or wasn't very energy independent. They were very energy dependent on other countries, primarily Russia. So then when Russia decided to invade Ukraine, this essentially turned off lots of different energy sources, from natural gas to petroleum to coal, to these European Union countries. Now what does that do? When you have less supply of this item and the demand is still there, actually the demand is rising because now we're coming out of the pandemic, people are starting to go back to work, people are starting to travel again, so energy demands start to go up, and now you have less supply, the prices of this energy skyrockets, and this created that energy crisis in these European countries, because now you have to pay so much more money to heat your home. You have to pay so much more money to pump gas in your car. You have to pay so much more money to really just do everything, because when you have higher energy costs, the cost of everything, doing business to buying products, gets more expensive. And this has accelerated that inflationary problem. But then on top of the energy crisis, because this energy issue is still going on, you also have issues in the economy, such as the real estate market. Now, the European countries do real estate a little bit differently than the United States, because in the United States, we are very fortunate to have things like the 30-year fixed rate mortgage. You don't have that in Europe. And what you do have is adjustable rate mortgages. That is your standard, something like a 5-year term that readjusts with higher interest rates or lower interest rates, depending on where interest rates are. This way, banks have less risk, because now they're only really guaranteeing you an interest rate for a certain number of years. Well, now, what we've been seeing happen in Europe, Canada, the United States, and many other places in the world is that interest rates have gone up significantly over the last 3 years. We went from the lowest interest rates ever in 2020 to now rapidly increasing interest rates. This has been the same story in many different parts of the world. Well, in the United States, if you bought a home in 2020, 2021, even in the early parts of 2022, and you got a, say, 3% mortgage, 30-year fixed rate mortgage, that 3% rate is locked in. Even if mortgage rates are 8%, you're still only paying 3%. It doesn't matter what's going on in the mortgage market because you got that mortgage locked in. It only really plays a factor if you wanted to sell your home and buy a new home. By the way, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the global economy, the housing market, the stock market, our own economy, and crypto. It's a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and it's free. So if you want to read Market Briefs, I got the link for you down in the description below, or you can also go to briefs.co/market. Now, if we compare what's going on in the housing market in the United States versus the housing market in the EU, the issue in the EU is that, well, you don't have these 30-year fixed rate mortgages. You have things like the 5-year term, which readjust, which means your interest rates are going to change depending on where interest rates go. And so you have all these people that bought homes in the last few years, and mortgage rates have gone up significantly in the EU. There's a similar issue in Canada. They have the same exact thing going on. And so now, because they're not fixed rate mortgages, you have a lot of people who are homeowners thinking, oh no, what's going to happen in the next 12 or 24 months when I go to the bank with the interest rate readjusts? If mortgage payments are twice as much as what I'm paying right now, on top of the higher energy costs, on top of the higher food costs, on top of the higher transportation costs, I'm not going to be able to afford these housing payments. And the other issue on top of that is that home prices in the EU have already begun falling. So now let's think about this. If you own a home, let's just say you bought a $300,000 home, and now the home is worth $280,000, and your monthly payments are whatever they are, and now you go to the bank to readjust this mortgage. Well, now the bank might say either A, your payments are going to double, or B, we can't refinance your home because you are now underwater or you don't have enough equity in the home. So you have to bring $10,000, $20,000 to the closing table because you don't really have any skin in the game. Because in the first few years of you owning a home, you don't really build much equity. The reason being is your mortgage payments are front loaded. This is pretty universal across most places in the world. I don't want to say everywhere because there's probably places where this does not apply. But many places in the world, your interest payments are front-loaded, meaning the majority of your payment, your mortgage payment, is going into the bank's pocket in interest. So if you make a $1,000 mortgage payment in month one, most of that $1,000 payment is going to interest, and a small piece of that is going to your principal balance. If you get a 30-year fixed rate mortgage in the United States, it takes about 14 years before the majority of your mortgage payment is going to your equity balance. So if you make a $1,000 monthly payment, you have a 30-year fixed rate mortgage, for the first 14 years, more than $500 of that $1,000 payment is going directly into the banker's pocket with interest. And then after 14 years, close to the 15-year mark, that's when $500 or more will start actually going towards paying down your principal balance. So in the first few years of you owning a home, you don't really build much equity at all. And so now, if you start to see home prices fall, with mortgage rates rising, that becomes a big dilemma when you have these readjustable mortgages. And that's how it is in the EU. That's how it is in Canada. And so this starts to create a big dilemma because you're already seeing an economic slowdown. You're already seeing the high inflation. You're already seeing this energy issue. And now the central bank is facing a tough question. What do we do? Do we keep raising interest rates and putting more downward pressure on the economy and housing prices and everything else? But hopefully this will cool down inflation, because remember, inflation is still around and this is hurting the average person. We've seen the impacts of inflation here in the United States. You know how inflation makes everyday people poorer. Or do they start cutting interest rates, which then could boost the housing market? They can make a mortgage rate cheaper, but that's going to make home prices higher, and it's going to make homes less affordable, and that's going to make inflation a bigger issue, because we've seen here that when you cut interest rates, demand goes up, people start buying, and that makes the prices of things go higher. Or do you pause and just wait and see what happens and hope for the best and hope for the fairy dust? And if you're wondering, but Jaspreet, well, how does this impact us here in the United States? Well, it impacts us a few different ways. Number one is because the EU countries are major trading partners with the United States. They buy a lot of things from us. So if their economy is hurting, then they can't buy things from us. It hurts our demand, hurts our economy here. Second, because this kind of can help show us or help us kind of expect things that could potentially happen in the United States. Many people assume that the United States here is immune to any sort of economic risk. Well, that's not the case. The EU is struggling. And if they continue to struggle, not only could that foreshadow what could happen in the United States, but that could also impact what's happening here in the United States. And this is where you want to understand that there's a lot of things brewing. And as time goes on, if interest rates stay high, this is going to impact many different facets of the economy. Here in the United States, we have 30-year fixed rate mortgages. That's good for consumers. However, businesses don't have 30-year fixed rate mortgages, and our national government doesn't have 30-year fixed rate mortgages, and your credit card payments are not 30-year fixed rate mortgages. And in the next 24 months, we're going to see a big chunk of corporate debt readjust. And we're also going to see a huge chunk of commercial real estate debt readjust, because commercial real estate debt is not a 30-year fixed rate mortgage. We're going to see trillions of dollars of commercial real estate and corporate debt readjust in the next 24 months. And if interest rates stay high, well, that means businesses and commercial landlords are going to be facing much higher monthly mortgage payments. And if they cannot support these higher mortgage payments with their higher incomes during a time where spending could potentially be slowing down and revenues could be slowing down, that's when you can really start to see that debt crisis start to spiral out of control. And this is why I keep saying 2023 is not the year for you to go out and finance a new truck. This is the year for you to get financially smart, understand what's happening right now. That way you can make the best decisions for yourself, your family, and your community, because this is where you want to be working to build that financial education and that financial preparedness. And with that, I'll see you tomorrow.